I'm sure my trouble was my trouble caused. All right, we call the Las Vegas Investment Committee to order. And won't necessarily do a roll call, but just for the record in terms of who attended, Rusty McAllister is here. Scott Edwards is here. John Billett is here. China Hill is here. Myself, that's 5, so good quorum. I guess the first order of business is last meeting's minutes. Does anybody have any corrections or comments? I didn't have any. Rusty, did you see what we did with Nationwide? I'm sure you're okay with all that.
Yes.
Have you left something on the table for you today?
Although I won't vote on the minutes because I was there.
So can I have a motion to approve the minutes? All right, all in favor say aye.
Aye.
Opposed? So the minutes pass. All right. I'll turn the rest of the agenda over to you for a while there, Rich.
Okay, thank you. Nice to be with you all again as we review the first quarter, 2015, and we will start with the Mass Mutual book. And you might notice that we have a new look here in our reporting tool. And so behind the curtain, Morgan Stanley explained this is the next evolution. They think it's better. So we'll get at least visually. I'm indifferent to it. It has a lot of the same components and modules, and we'll get through it. And it's nothing material changes as far as I can see. So in Mass Mutual, we'll start with tab 1, page 2. And the capital markets overview, I'll highlight global risk markets were highly volatile in the first quarter of 2016. The worst January in global stock market history gave way to a retracement in February and March, leaving U.S. stock owners about even and international positions down about 3 to 5%. Investors grappled with fears of a global recession, ineffective central bank policy, a China-driven currency war, and declining oil prices. For the quarter, gold, emerging market equity, and real estate investment trusts posted the strongest returns over the last rolling year period ending March 31st. Gold and global investment bonds were the top performing asset classes. The Dow Jones Industrial Average was up 2.2% for the quarter. NASDAQ was down 2.4%. The S&P 500 increased 1.3% for the quarter. 8 out of the 10 sectors within the S&P 500 generated positive returns. Top performing sector was telecom, up 16.6%. Utilities up 15.6%. The biggest laggards were healthcare, which is down 5.5%. Financials were down 5.1%. Morgan Stanley economists expect real U.S. GDP to be 1.7% this year, 1.6% next year. So decelerating a little bit going into next year. However, global forecast growth.
What was it for 15? Do you remember? Anybody remember what was in 15?
For the year?
The GDP?
1.8 or something like that.
I will confirm that.
It was more than 1.7, wasn't it?
Not much. The fourth quarter was bad.
I'm just curious. Sorry, that was new.
That's okay.
I just didn't mean to throw you off your game.
Not at all.
I'm sitting there. This is not a bad for you.
But the trend for the last few quarters is projecting decelerating growth domestically. However, global growth forecast to be 3% this year and 3.4% next year. Commodities were down 0.4% for the quarter. Gold was the top performing asset class, up 16.5%. Page 7, or excuse me, page 3 in this tab. Capital markets, U.S. economy. Department of Commerce estimated the gross domestic product increased annually at 1.4% in the fourth quarter, in comparison to 2% increase in the third quarter of 2015. Unemployment rate for March 2016 was 5%, showing a 0.1% increase from its February level. Employment gains occurred in retail trade, construction, healthcare, while losses occurred in manufacturing and mining. Inflation remained low. Consumer price index was flat in January and was down 0.2% in February. The Morgan Stanley economists forecasting 1.2% inflation rate for 2016, but picking up next year to 1.9%. And these are the indicators and that factor in the Fed's decision on interest rates. Private sector housing starts in February 2016 were seasonally adjusted annual rate of 1,781,000 homes, 31% above February 2015 housing starts. Retail and food services sales decreased 0.1% in January and February, and increased 3.1% between February 2015 and February 2016. In March, Purchasing Managers Index, or PMI, the manufacturing sector index, increased as the PMI registered 51.8%, a 2.3% uptick from February reading of 49.5%. This indicates an expansion in manufacturing for the third consecutive month and its highest reading since July 2015, when PMI registered 51.9%. Next page, U.S. equity markets. We touched on the index returns. You see there down in the box in the spreadsheet, S&P was up 1.3% for the quarter, 1.8% over the last trailing 12 months. Dow up 2.2% and 2.1%. The small cap stocks, Russell 2000 down 1.5% for the quarter, down almost 10% trailing 12 months. Mid caps up 2.2%, down 4% for 12 months. And Russell 1000 large cap stocks, modest gains. From a style perspective, the Russell 1000 Growth Index rose 70 basis points, and the Russell 1000 Value Large Cap Index increased 1.6%. Just anecdotally, for probably the last 5 years, growth, based on the cycle of the economy, growth has outperformed value, and now as things are slowing down a little bit, it's the dividend-paying stocks and the value style is now kind of taken over and leading the way. The Russell Mid-Cap Value Index increased 3.9% for the quarter, and the Russell 2000 Index decreased 4.7% for the quarter. And then the Russell 2000 Value Index increased 1.7%. Global equity markets, the EAFE index, which is the index for developed countries around the world, was down 2.9% for the quarter, down 7.9% last 12 months. Europe was down 2.4% for the quarter, down 8% for the last 12 months. The emerging markets finally picking up 5.8%, down 11.7% for the last 12 months. And finally, in the bond market, was positive for the first quarter. Interest rates declined during the quarter as the yield on the 10-year Treasury note fell to a quarter-end 1.7% from 2.27% at the end of the fourth quarter last year. So the Barclays Capital U.S. Average Index was up 3% for the quarter, and high yield was up 3.4%. Now, if you move forward to page 16. So there's our watch list. So again, different visual as the previous book, but the content is the same. Now, 1, 2, 3, 4, there's 5 funds here, but it's not that bad. The Putnam High Yield Bond Fund is being consolidated with Hartford Total Return. Hartford Capital Appreciation is newly on watch. MFS Utilities is being replaced with Franklin Utilities. And then down below, American Funds Capital Work Growth is being replaced by Hartford Global Growth Fund. And that's happening next month. If we go to page 18. And again, this is a new twist on the style maps. This new software provider has chosen to separated out in 2 different pages. So you got your money market, target date funds, your balanced open market equity income, the bonds, Hartford total return, Pimco real return, which is inflation protected. There's a Putnam high yield, again, that's being consolidated with the Hartford total return. And then on page 19, you've got the equity representations. Pretty nice picture when you consider not cluttered up with too many choices. And the other thing that I will point out to you is in the previous book, the watch list funds were in red. So now there's a little bit of a key. The watch list is just an asterisk. And then the line with the 2 slashes, funds that are not in compliance with the IPS, either they're below the 50th or 3 or 5 or both. In the foreign equity, again, American Funds Capital World Growth and Income is being replaced by Hartford Global Growth, and especially the MFS Utilities Fund is being replaced with Franklin. Moving to page 25. Here's your asset allocation. And again, polarizing number of 49.59% is in the stable value fund, 4% crediting rate, gone up a little bit. That can either be from money moving in that fund or by virtue of the equity funds going down in value and the stable value becoming more larger on a weighted basis. Page 26. Here is the plan. Here are the plan investments with their values. Again, 70 million in the Hartford General account. You'll notice going down the T. Rowe Price, it stops at 2055. The 2060 is in fact in the fund lineup. It's represented on the plan sponsor page. Out there's no money in it yet, so it doesn't pick up as a balance. Now, if you go to move forward to page 28, here's our investment policy criteria. Top 50 percentile 3 and 5 year. Go to page 29. Here's our all-important rankings. Going down, Hartford total return, steady. Now the Pimco real return is worthy of a discussion. So on the 3-year, 5 years not an issue. 25th percentile. Last quarter was 27, and the quarter before that was 25th. However, on the 3-year, 2 quarters ago it was 61st percentile. Last quarter was 70th, and it stayed at 70th. So certainly open for discussion if that should go on watch based on the 3-year, or we can continue to monitor it for 1 more quarter. Not on watch.
I mean, I'm sorry.
Putting it on.
It doesn't meet the consent criteria for putting it on watch.
Yeah. Okay, so we'll continue to monitor it, and then next quarter address it at that time. Moving down, Putnam high yield. Mediocre on the 3-year, not good on the mediocre on the 5-year, not good on the 3-year, but it's good because it's being consolidated with the Hartford total return. Then you go down to the target date funds, rankings are superb. And then get to 2016 fund has been added. Go to page 30. Open market equity income, that's our balanced fund, approximately 60 stock, 40 bonds. Steady rankings, Hartford dividend and growth. Very steady rankings. Hartford and Wiley mid-cap value, very solid on the 5-year. However, on the 3-year, under a little bit of distress. 2 quarters ago it was 25th percentile. Last quarter it fell at 57. Now this quarter is 81st. Presumably monitor it, and then it's below the 50th next quarter. Discuss action, and I can certainly come with. Well, we can put it on watch at that time if we decide to.
You say it's fallen for 3 straight quarters?
It has.
I don't know, but I think I would say put it on watch now and maybe look for something to possibly move it to. Because it is falling 3 straight quarters on the 3.
Yeah, well, but more significantly below the 50th,
Yeah.
the last 2. And that's certainly a good option.
That would be my thought.
If that's the case, do you want to do the same thing then with PIMCO real returns? Since it's at, I believe you said it was declining for the last 3 quarters too, Freddie?
Yeah.
I mean, if we're going to have a consistent policy, we should have a consistent policy.
Right.
Yeah, so that's a very good point. And if you want to go back to PIMCO total return and put it on watch, I mean, for the same reason you would put Hotchkiss and Wiley on watch, even more so now, really on PIMCO real return, because it's been below the 50th for 3 straight quarters in that thought process. So, Mark, any thoughts, comments?
No, I guess what's rattling around in my head is the fact that it's been underperforming to the midpoint. 3 straight quarters. It's a direction it's going, but I don't know that it gets me too excited. The fact that they're both relatively low in the 3-year return. It's probably more significant beyond what the PIMCO was 70, still 7.
Yeah.
70. And what did you say Hotchkiss was?
Well, it's 81st on the 3-year. Last quarter was 57, and then 2 quarters ago was 25th.
So the Hotchkiss is actually performing worse as we roll through the 3-year cycle, whereas the PIMCO's kind of hanging in there. It doesn't change that much.
Right,
So
it stayed at 70.
But still.
You know, I think you can get maybe even a little bit better picture of the trends if you look at, if we go further down when we talk about in your chart, Freddie, I don't know how many pages back here it is, but if you look at the PIMCO total return, it's 70% on the 3-year, but it's 74 in the 1-year. So it's trending down 70, down 74. And the Hotchkiss is actually, what was it? It was worse, like for a 1-year rate of return, it's in the 90 percentile.
Yeah.
3 years, 81%. So it's, the 3 years bad and the 1 year's even worse.
Yeah.
So I don't know if that's a trend, to follow or.
Yeah, I guess if we want to put them both on, Julie's thought was putting them both on watch. I don't have a problem doing that.
Yeah, and I think we should put both of them on.
My only thought was we give them another quarter before we decide to.
I'm good with that
We're
too.
looking for something, so, yeah. So you want to make a motion, Jim, on both of those?
Well, is there any others that were on there, Freddie, that we need to look at?
Yeah, let's finish the.
Or some others over there?
Anyone tell us about Hartford Capital Appreciation?
Yeah. Hartford Capital Appreciation, you know what, on the agenda, and I beg your pardon, are consent items. And on Mass Mutual, there's Hartford Small Company, we'll get to it. We don't have to vote on it, but it's on watch. So we'll get to it, and I'll highlight that. So moving down, Invesco, excuse me, I just want to make sure, at this point, you want to review the funds and then go back and then confirm, monitor, or watch the two funds we just talked about? The PIMCO return and Hodgkinson Levy? Because there was no motion made
Yeah, well,
on those two funds.
do you want to make a motion on the two we've looked at so far, or individually? Because we're going to have some more.
Or do you want to wait till we get through these, because there's some other ones that are?
Yeah, there's some
I
coming up
wait.
in the next page.
Okay.
I like waiting.
All right, that's fine. So Hartford Capital Appreciation has been on watch last quarter. And so the 5-year, it's an 87th percentile. Last quarter it was in the 75th. And last quarter on the 3-year it was 29th and fell to 59th. And on this, I would suggest considering keeping on watch, and I'll come with a fund search next quarter, if in fact it's still failing, I guess.
Okay, do we need again, do we want to have a motion at the end to figure that out, or do individually we want this one because you're going to come up with another fund search on it?
We can,
You got several others that are going to have fund searches too, it looks like.
Yeah, it looks like there are.
Okay, so moving down, Mass Mutual Select Ops, very seldom 3-year, excuse me, I beg your pardon, very seldom 5-year, however, on 3-year. 2 quarters ago it was 53rd, last quarter it was 32nd, dropped to 67th, but I don't believe any action needs to be taken on that. Hartford Mid Cap Growth, performing beautifully, ranking very nicely. And here's the consent watch. No need to take a vote or make a motion. Hartford Small Company is on consent watch. MFS International ranked 1-1, and we consolidated with that at some point in the past, and that was a good move. And then American Funds Capital World, although it has improved a little bit, that is being replaced with Hartford Global Growth. Moving down, MFS Utilities is being replaced with Franklin Utilities. And then Hartford Healthcare, performing nicely, ranking nicely. American Century Real Estate is on watch. 2 quarters ago, it was ranked on the 3-year 56th. Last year, it fell to 60th. This quarter, it improved to 56th, although still below the 50th. And 5-year, 28th percentile this quarter. Last quarter was 24, and 2 quarters ago was 17. So it's declined a little bit, but still, very solid 28th percentile. And now, turn our attention back to the 3-year. It has been below 50th for 3 quarters. However, it did improve from the 60th to the 56th. And that's it.
okay, let me repeat kind of what I thought I was hearing from you all. PIFCO rail return, put that on watch. Putnam high yield watch.
Excuse me, Mark. Putnam High Yield is being replaced.
Oh, I'm sorry.
Yeah.
Got it. That's why I'm repeating. Exactly.
Yeah, so it's PIMCO, and then Hodgkin's Wiley Mid Cap.
talking about doing a search for that. And what are we doing with the Hartford Small Company?
That one is down
We're doing a search for that. Hartford Small. That what we said?
there. Yeah, and then the MFS utilities, you said we're already moving that one, right?
Yes, yeah. And so Hartford Appreciation, I was to keep it on watch and do a fund search. And there was no official motion made for this.
Yeah, we're just trying to make sure we cover all of
Okay,
them
yeah.
down there.
Okay, yeah, sorry. So, all right, so once again, let me see if I got this right. So Pepco Rail Return, we were putting on watch. Hutchins and Wiley also on watch. Hartford Capital Appreciation, we were asking Freddie to do a search. And the same, I thought with Hartford Small Cap, small company.
Okay, so,
What we said,
yeah, so Hartford Capital Appreciation,
search. And then Hartford Small Company, also search. That one's down.
yeah, so just to be clear, the Hartford Small Company Fund is on consent watch beginning this quarter. So if it's still below the 50th next quarter on 3 and 5 year, I'll be prepared with a fund search. If it's not,
The thing
then,
that strikes me is how low it is.
yeah, okay, then I'll do a fund
It's
search.
81 and 75.
Okay.
I mean, it's pretty,
I don't think one quarter is going to bring it up in
yeah.
the top 50 in either of those
Yeah,
categories.
Just-
Yeah,
I don't
either
think
one.
we
I was
need to
guessing.
search it anyway.
Okay. Okay, still pending a motion for 4 funds. My name is Pepco Rail Return, put on watch, Hotchkiss and Wiley Mid-Cap, put on watch, Hartford Capital Appreciation, and Hartford Small Company, do fund searches.
That's my motion.
I'll second
All in favor, say aye.
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 Opposed? Motion passes.
Yeah, if you look at that Hartford Small Company, it's in the bottom 70% all the way back to 10 years.
Yes.
Okay, and so that really completes the fund review for Mass Mutual. Now on to ICMA.
Can I ask you a question before we start? Just because I haven't looked at it too carefully. Page 22.
On Mass?
Yeah, yeah, I see.
I see.
It's,
Yeah.
I think this is a new chart, isn't it? I'm just trying to understand.
Yeah, you know, this is a new, and I was going to include that as I go through it. You know, it's just in the other software we had, it was in a kind of a bullet point version of fund highlights and quantified returns.
These are our best performers and worst performers? Is that
Right.
what this is?
That's right. And again, this is very supportive of.
But it doesn't list all the funds, that's what
No.
caught me off. So
Yeah.
how does it pick these? Is it the asset size, is it a combination?
Well, and really
If I
the
read the
best,
footnotes, it probably answers my question.
well, it's the best performing funds, the 5 best performing funds and the 5 worst performing funds. And it's interesting because when you look at investment diversified dividend of 5
But these are best and worst, but they're not relative to their class.
No.
They're just performance.
That's correct. And what you'll find as a theme is that you've got investor diversified dividend, top performer 5.27. You got Wells Fargo special or mid-cap value up 3.6%. Now at the bottom, you've got BlackRock mid-cap growth down 48, T. Rowe Price growth down 542. So again, it's another indication that value as a style starting to take the lead now in the marketplace.
That helped. Thanks, Rich.
Sure. So going to page 16. There's our watch list. Now, one of the things I wanted to bring up is that the Vantage Point Milestone Retirement Income Fund is on watch, and it's below the 50th percentile, and we'll get to the rankings. But we've talked about it several times now with the target date funds come as a suite, and I would consider why keep that on watch when we know it's one fund in the suite that's not in compliance, and especially when you consider the IPS amendment we made last quarter with special language around review criteria for the target date funds. It doesn't hurt to have it on watch, but if we put it in the notes, the minutes, that decision was made based on those two criteria. We can always put it back if the whole series does terrible, but
Well, that was going to be my question.
Yeah.
Is there a way for us to maybe by policies? I agree with you, it doesn't make any sense to put one of the individual funds for a whole suite of milestone or time funds on watch. But then that begs the question, so what's our criteria for the whole suite?
well, the whole suite. So we still have our 50th percentile for 3 and 5 years, top 50th percentile for all the core investments across the plan, and that is still our first performance criteria for the targeted funds. However, last quarter the amendment was approved, the new language was added around the targeted funds where those could have different evaluation criteria based on and we've talked about this because they're equity heavy, they're going to have more weightier equity exposure across different parts of the glide path as they're managed through retirement after the targeted fund analysis that was conducted, selecting across the 300 keepers those characteristics of managed through retirement. And so that being said, let's suppose we went into a really bear market and you've got all these retirement date funds for Mass, ICMA, and Nationwide that have a through glide path, and then when you have the Morningstar category rankings, they don't discern or distinguish between a to glide path and a through glide path. So again, you really got a really bad equity market and a recession or whatever the case may be, the equity heavy funds, intuitively would go down in value more than funds that had lighter equity exposure. That doesn't mean you have to completely blow up the suite of target date funds and replace them, because remember, you, as a committee, selected that type of a target date fund based on the target date fund analysis we did of average account balances 90,000+, ability of the first deferred defined benefit plan.
Well, they're weighted heavier on the equity side, but it's adjusted over time towards your retirement date. And it seems to me to mess with these a whole lot when you have, these cyclical bear markets would be counterproductive.
Well, it would. I think.
I'm saying the same thing you are. I'm just trying to say. So at what point, and then maybe we don't really talk about. I'm just asking myself, at what point do to say, hey, this Danish Point Milestone not working for us as a suite, we want to do.
I think that was the question
That's
that
right.
I asked
Yeah.
at the last meeting, was
Because if you
how are we
do them
gonna
individually,
determine?
it'd be a whole suite
Right, it's
decision
the
that
whole
this
thing,
isn't
how are we
working
gonna
anymore.
determine that we need to do something about that suite?
Yeah, well, then
You
in
know,
that
we have
case,
to come up with something that tells us, okay, if you have 1 or 2 or 3 bad funds in the suite, or if you have 2, I mean, where are we making the determination on the suites?
okay, and there's some subjectivity, and the language, you know, it's important to note that the language that was put in the IPS, the amendment, the language around the targeted funds, is to give you some leeway. It's to give you, you know, some bandwidth and not be so objective on the rankings themselves. But I think that, you know, if we were to get into a situation where, you know, for an extended period of time, you know, quarter after quarter, and that, number one, they fell below 50%, well, that's one thing, and we're not there yet. If that were to happen, so that would be the first, you know, wake-up call. Then if we were to continue to fall deeper into the rankings, then we would, you know, intuitively know, and I would lead the way, and I would offer to try to do then an analysis, a comparative analysis between other targeted funds that are managed through retirement. Because again, you know, if you have the equity-heavy funds and they're going down, it's really not fair to compare them to equity-light funds, because it goes back to the analysis we did, that through funds, you know, higher equity exposure is really more appropriate for the city employee demographic. And then I can see if I can identify some suitable replacements in comparing the through glide path that we have with other through glide path suite of funds. And I don't think there's really any other way you would go about it than that. So back to just,
You started this all, it's not your fault.
Okay.
You started this all by saying, you know, I'm just joking. You know, why we keep this on why, I mean, it shouldn't, I'm having it's not, you don't have it on watch per se, it just doesn't meet the IPS criteria.
right, it has been on watch.
Just put on watch at
12:31.
Well,
Yeah.
but
Yeah.
this is
Yeah, so, yeah, on page 30, you can see the rankings on the 5-year. So, I mean, it has been on watch. And it's gotten above the 50th percentile on the 3-year. You know, or we could keep it on watch. I'm just saying, if you just take it off watch, given the IPS criteria, the language, the amendment, one less fund on the watch list, because again, for it to just be perpetual on the watch list where it's really not subject to any action anyway.
Well, it would take, you know, just kind of talking backwards, I mean, it would take more of the Vantage Point Milestone funds to be on the watch list before we consider taking action on the whole suite.
That's what I keep asking for. What is the defined number
We don't.
of things on the suite before you would be concerned?
There's no defined number, and that's a good thing because it allows you some subjectivity. And as a committee, you know, you don't want to be so constrained that if you don't follow, you're in violation of your own statement, your own policy statement.
Okay, so here's my thought on this. So maybe you leave it on the watch. don't talk about it. Until we see, no, until we see, because the problem is if we vote to take it off the watch list, then we'll forget that it was at one point. And so when does it go back on the watch list? The next quarter? But it's still probably got an issue.
Okay, well,
And I'm just thinking, just leave it
Yeah.
on, and we'll, and unless there's something else going on with the suite we need to talk about, then there's no reason to talk about it.
okay, and there's no right or wrong
We
answer.
just leave it there, because if we take it off, then I may forget,
Okay.
where it is. So maybe we just leave it there. That sound okay? Good enough that I need a vote of motion. All right, we probably will tell us for that. That's all your fault.
It is my fault. Okay,
All right.
and then back on page 16 now, Vantage Point Discovery T is being consolidated with the mid and small cap index fund, and there's only 30,000 in the Vantage Point Discovery T. So next quarter, the watch list, barring any new watch list funds, looks very clean. Look at page 17. Now, you'll notice the Dreyfus Cash Management, that's a money market fund that we're going to be talking about, another agenda item to come, because we have to address what we're going to do with that, given the money market reform happening. Target date fund suite, again, when committee approved adding the 2060 fund, ICMA is even close to being able to offer that, but they're working on adding the 2055 fund sometime in July. So I'll keep you apprised of that. Page 18, the equity funds in mid-cap value, Vantage Point Select T is being consolidated with, has been consolidated with Wells Fargo, a special mid-cap. And then in the small cap space, small cap blend, as I mentioned, Vantage Point Discovery T, next month is being consolidated with Vantage Point Mid-Small Company Index. Moving ahead to page 22. We already touched on that page. Values outperforming growth. Moving to page 24. The asset allocation, I think, is pretty healthy across the plan. I'll credit the education specialist, Ornella Gross, for helping shape that. Page 25. The fund values, and again, there's a Dreyfus Cash Management money market portfolio, 236,000. Incidentally, there are 16 people in that fund, 11 people in 457B and 5 in the 401A, 16 participants. Page 26, ICMA value at $48,935,313. Page 29, and there's the rankings. Western Core Plus, there's our Core Plus bond fund, ranking beautifully. Vantage Point Flex, inflation focused T, good rankings. And again, there's the milestone target date funds, very, very steady rankings. Most of them are top quartile rankings. Going to page 30. Fidelity Puritan, ranking beautiful. There's the Vantage Point retirement income. It's on watch. Stay on watch below the 50 percentile on the 5-year. Large value funds, American Beacon, ranking beautifully. Westwood Diversified Dividend, ranking beautifully. Vantage Point Select Value T has been consolidated with Wells Fargo Special Mid Value. And moving forward to page 31. Large blend, S&P 500 doing fine. Vantage Point Growth and Income T doing fine. Vantage Point Discovery T being consolidated with Vantage Point Mid-Small Company Index. Large growth, Fidelity Contra Fund, T. Rowe Price Growth Stock, Advisor Share Class, all ranking nice. BlackRock Mid Cap Growth Equity, great rankings. Oppenheimer Discovery, very good rankings. Vantage Point Overseas Index, steady. Last quarter on the 3-year was ranked 39. It dropped to 49, but still in compliance. And in the 5-year, last quarter is ranked 34. It dropped to 40th, still in compliance. Fidelity Diversified International, doing fine. And on page 32, the Navy Real Estate Fund, last quarter of the 3-year was 23rd, declined to 29, still nice. 5-year, last quarter 21st, dropped to 22nd. So all in all, pretty clean here with ICMA. Now, if you can please go back to page 18. So there's the style boxes for the equity, and again, the Vantage Point Discovery T only has about $30,000, and we're consolidating that with the Vantage Point Mid-Small Company Index. So, you know, in theory, if you're building a portfolio, you can have the Mid-Small Company Index and get exposure to just that mid and small in the blend category. You do have an Oppenheimer Discovery wide small cap growth fund, and the consideration is to look at adding a small cap value fund to the lineup. There's nothing wrong with the way it is now, because again, if a participant wants small and mid-cap exposure, they could invest in the Vantage Point's mid-small company index and get that exposure. In the mid category, they can, you know, they have a value fund and a growth fund, and as I mentioned, if somebody is, you know, really has, you know, paying attention, is getting some asset allocation advice by some higher source, and might want to overweight value as a starting to outperform growth, they have that opportunity in the mid-value space. So along that same methodology, that's the consideration adding the small value fund. And so I've included it in your handout. Now I want to tell you, the committee, that this new software, you know, what I've been doing that seems to be working is that we've got the big review books that you have on your pad on the screen, and when a fund search comes up, I supplement it with a paper that you can page through while still on the fund we're talking about replacing or adding. This new software does give us the ability to actually add funds in this box in green, that funds we're considering. If there's a fund category that is under pressure, fund search for replacement, and then this essentially that I print as a piece for you can be in a section in the book, the page through on the screen on your tab. And I want to hear to your preference. Does anybody have any thoughts on that? Would you like to make status quo if you've done it, or incorporate it into what you see on your pad and on the screen?
I'd rather incorporate it in so we had it ahead of time.
Pardon me?
Incorporate it into the package.
Oh, you would?
Yeah.
Okay, so not come in with printed copies?
I don't know. If it's there, I don't need a printed copy.
Okay. Will you be going back and forth? But if that's not a problem or any inconvenience, then does anybody else have any preferences or thoughts?
No, as long as we have it ahead of time to look at.
Yeah.
Okay. Okay. All right, so on the fund search, if you go to page 9, three very nicely ranked funds. This undiscovered managers behavioral value fund, the best, and 1 of 1. Go to page 10. This is just an indication where, any fund that I recommend in here or bring as choices, Morgan Stanley has either approved through their proprietary screening algorithm, good qualitative, quantitative fund, or they have direct global investment management research on, so all these funds pass that grade. Page 11, here are the returns and the rankings, and you see for the first quarter, Wells Fargo did the best. Year to date, it's the same number. Over a 1-year period, the undiscovered managers behavioral fund is the best on the 1-year, 3-year, and 5-year. There's those rankings, 1, 1, and 1. Highest alpha. Wells Fargo has the lowest beta, but the undiscovered has the highest Sharpe ratio. Although the Wells Fargo has the least standard deviation. So undiscovered looks very, very compelling.
I'm getting a chuckle out of that name. Does that officially mean that the era of celebrity fund managers is over or something?
It's funny. I look at the undiscovered. Well, it's out of the bag now because we just discovered it. So we got there first. So.
It's an interesting name to choose to name your mutual fund company.
I think it's the undiscovered is a reference to a fund manager trying to find intrinsic value in a company that he sees appreciate the value. So page 15 are the expense ratios. Wells Fargo is the least expensive. Undiscovered management behavioral fund is in the middle at 1.11%. And
anonymity isn't cheap.
exactly, yeah. Well, it's less anonymous now, but
it's incredible to me that it's fund's been around since '98, and it's never been in the 1, 3, 5, 10-year category been worse than second, where they're like 3 firms.
and then page 13 is helpful, because you can see the calendar year returns, and again, always going back to 08 is how to do in that distress. But 2015, last year Undiscovered did the best. 2014 Wells, 2013 Nuveen, 2012 Undiscovered, 2011 Nuveen, 2010 Undiscovered, 2009 Undiscovered, 2008 Nuveen was down the least, and it also performed best in 2007, 2006. So the first decision is there a preference to add the fund? And if there's not, then the rest is smooth. If there is an appetite to add the fund, to give people that small value opportunity, then select the fund.
I guess part of when we look at our diversification chart, as we've talked about before, when you got a mid-cap, if you got a value on the road, you can create a blend, right?
Yep.
And when we come down to the small cap, we already have a mid-small blend fund, and we have the Vantage Point Discovery, which is also both of them are listed as blend. so I don't know.
Well, Vantage Point Discovery is going away, because it's being consolidated,
So-
yeah.
I mean, what would we do if we added, we wouldn't do anything with Vantage Point, mid-small company index, right?
Right. Because that is giving people exposure to small and mid blend and
It's a
core.
little bit different.
Yeah.
It's a little bit different.
Yeah, it's a little bit different.
So based on that, yeah, I mean, if somebody wanted to just be a small blend, there's not necessarily where you're going to do that.
Yeah. Yeah, or the other concern and consideration, I should say, is that if we're going to allocate, 10% small cap in general, and they're working with an advisor and who compels them to overweight, value, they can put, 6 and 4, value growth or whatever the case may be.
Well,
Except we
based
don't have a
on,
value option today.
Right.
That's what we're.
Yeah.
based on some of the points that you brought up earlier with regards to where the market appeared to be headed,
Yeah.
moving away from growth and moving back into value,
Mhm.
it would make sense to me maybe to add the value opportunity
Yeah,
to give them that choice if they wanted it.
Right.
Uh,
Okay. Any other discussion?
I'm just shocked Freddie's suggesting new funds.
Yeah, so now,
Mr. Consolidation is turning.
no, that's why,
Although,
that's sort of why I asked the question.
I'm open and objective.
I had forgotten that we talked about venture discovery T going.
It does seem to fill a square in the box, so to speak. And
Yeah. And it really gives more options, because, aside from adding this fund, another option is that, if somebody just wants exposure to small cap space and wants a less expensive vehicle, they can get their small cap exposure, just in the small cap or mid-small index. And you're going to get growth in value. It'll ebb and flow a little bit. So it's just another option in adding the value fund. So it sounds like the committee's in favor of that.
And then, they all look good on kind of, just because of the name. I like the discovery managers.
What do you think, Rusty?
And then it'll be interesting to see with, the education efforts for ICMA, how much money actually, migrates into that fund.
Are you good with that one?
Yep.
Motion?
I move to add the undiscovered manager's behavior value
Second.
to the small cap sector. All in favor, say aye.
Aye.
okay.
Opposed? All right. What record share was added? New fund. We're not just, one dimension.
Okay, very good. And now moving on to,
Freddie?
yes, sir.
Just out of curiosity, so maybe I just missed it, what your plan is with this Dreyfus cash management stuff, what is it, what are you doing with that?
Well, we're gonna get to that.
We had that discussion last quarter, you were here, but
Right.
it was an interesting discussion, and I think we kind of tabled it to here because
Yeah.
we wanted to value your input.
Yeah, it's a
No,
very
you didn't.
important. Yes.
I know you better than
Yeah. We'll get through the reviews and then we'll come back
Yeah.
and address the money market exposure, the money market fund, because it's an ICMA and nationwide.
Okay.
Moving on to nationwide. 16, please. So the watch list is very clean, actually. So in February, Nationwide executed on those cost reductions, and that's why you see the Fidelity Diversified Stock Fund, A, and Fidelity Advisor Diversified Stock Institutional, both represented there as, during the court, they were both in the lineup. So really only one of those funds in reality is on the watch list. Does everybody understand that? Okay. Page 18, again, Dreyfus Cash Management, we'll be addressing the money market reform. You see in the BlackRock High Yield, same thing. There's really only one fund, but during the quarter they were both in the plan. That was one of the funds that was benefited from the cost reductions. And then page 19, same thing, MFS Mid Cap Value, American Beacon Small Cap Value, Valley Advisor Diversified Stock Fund, S&P 500 Index. Now the Oppenheimer Main Street Mid Cap A is being consolidated in July into Nationwide Mid Cap Index as approved last quarter. And again, the duplicate funds for the cost reductions, T. Rowe Price Blue Chip, JP Morgan Mid Cap, and then in the foreign equity, the American Funds Euro Pacific is being replaced with IB International in July. Page 23. Has mid-cap value up 3.8. All the growth funds down. Page 25. Asset allocation looks pretty good. The target 8 funds at almost 24%. Not so sure how many new enrollees are selecting that, but those are largely funded by the consolidation of the asset allocation funds that we did in adding the T. Rowe Price funds, complying with the QDIA election, and then funding them from the asset allocation funds. Page 26, fund balances, and you have the Dreyfus Cash Management, that's the money market, 248,000 that we'll be talking about, and incidentally, there is 26 participants in that, 17 of the 457, 9 of the 401A, and then moving 2 down.
So roughly about the same number as the
Yeah.
other fund.
Yep. With ICMA.
Yeah.
Yeah. ICMA was 16, and then the Nationwide stable value is 4,559,000, and the number in the middle is 748,000, and this was in the minutes to clarify. That is a balance that represents a cash alternative or a cash allocation inside the managed account. So if somebody signs up, elects, they have a managed account program where, someone's taking discretion on managing their, any allocation of cash, it's funded in the general account. So it's not in the Dreyfus money market, it's in the general account. Stable value fund, which is, credited 3.3%. It's very attractive.
So it's just the name. Sort of.
Yeah, yeah. Next page, 27. So the end of first quarter, we're at $31,870,937. Going to page 30. Moving down, Western Core Plus. Great rankings. So here's a very good example when we're looking at the cost reductions, looking at the BlackRock high yield, is that you can see that just by virtue of a smaller expense ratio and less drag on the performance, that the BlackRock High Yield Fund A ranks 32nd on the 3-year, when the fund we used to have with a higher expense ratio, the R share, retirement share class, ranks 43rd. So you're seeing tangible, quantifiable benefits of that cost reduction right there. Same thing on the 5-year. Everybody see that? Okay. T. Rowe Price retirement date funds, we know their rankings are superb. On page 31. Now, Columbia Select Value A is on consent, so no motion to put on watch, no voting is necessary. Effective this first quarter, it ranks below the 50th percentile on 3 and 5 year. MFS Mid-Cap, performing great. Rankings are superb. American Beacon Small Cap Value, superb. The Fidelity Advisor Diversified Stock A is under pressure. So on the 3-year, last quarter was 76. Excuse me, I beg your pardon. That fund is on watch. That fund is on watch, yes. And so last quarter, it was it ranked 76 on the 3-year, improved sliding to 75th, and on the 5-year, it's been at ranked 57 percentile for the last 2 quarters. So I would propose to obviously keep it on watch, and I'll do a fund search, come to the fund search next quarter. Moving down, S&P 500, doing fine. Nationwide mid-cap index, doing fine, actually improving. Last quarter on the 3-year, it was ranked 47th and improved to 41st. 5-year, it was last quarter's 46th, improved to 38th, so that's trending nicely. Page 32. Oppenheimer Main Street Value has been consolidating with the mid-cap index fund that we just reviewed. In the large growth space, T. Rowe Price Blue Chip. Again, you see with price cost reductions, ranking 5th, 5th, and 3rd, respectively. J.P. Morgan Mid-Cap Growth rankings are fantastic. UBS Small Cap Growth. On the 3-year, 2 quarters ago, it was ranked 27th. Last quarter improved it to 11, and now it declined to 57th. On the 5-year, 2 quarters ago, it was ranked 20th. Last quarter was ranked 10th, declined to 32nd. But I would recommend you just to monitor that. It is below the 50th on the 3-year. For 1 quarter. Moving on in the large foreign blend category, American Fund Euro Pacific is being replaced with IV International Fund in July. And then in the global stock category, World Stock, Thornburg Global Opportunities, ranking is superb. IV Energy, rankings are very good. American Century Real Estate, last quarter on the 3-year, it was ranked 60th. it improved to 56th. 5 years is not an issue. Actually, if you turn to page 33, that is a fund that benefited from a cost reduction. So there are no issues with it on page 33. So again, with the exception of the Columbia Select large value being on consent watch and Fidelity Advisor continuing, which I will do a fund search, pretty clean scorecard here nationwide. Any questions, comments, concerns? Okay. Now, there is a consideration for another fund addition. So now, if you please go to page 19. I would put this as a less compelling consideration as what we just did for ICMA. You see that, again, if you want to have allocation of small cap space, you have a value fund, you have a growth fund. You could theoretically, usually go 50-50 in those and create a blend, scenario, because, they're both, together going to meet in the middle to some degree. However, if you do want to add a blend, not to be, left behind, and Rusty, I think, you should certainly be a voice in this, in representation of the firefighters. If it was your account, what would your preference be? But if you start on page 9, well, again, first this question is, would you like to add a small blend fund?
I'm just looking here. Because of all the ones we combined here, it's hard to tell exactly how many funds we have total in the package here in the equities. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 12. So we're right in that. I looked on the last one we had, there was about 12 in the equity portfolio, and we added 1.
Mm-hmm. Just thinking back to when we first started this, the idea of trying to, I don't say keep options minimal, but if we're trying to consolidate, we've consolidated pretty well, I think. Yeah.
Decreased the rates pretty well. I guess I would ask you, do you see the value in adding that in at this time? I mean, yeah, it gives them another choice.
I don't think it's necessary.
I mean, I would agree with you if you want to blend. You can take half and half and put 50% in
Right.
value and 50% in growth, and you have your blend,
Right.
essentially.
Right. And again, I don't think this is as compelling as what we did on ICMA, because there was not an option for a small value.
I don't think personally, I don't think that our guys are screaming to say, give me a mid cap, I'm gonna give you a blend for the small cap equity market, give me a blend. I don't think I don't really hear our guys screaming for anything, but But,
Maybe ice cream?
huh?
Maybe ice cream?
Yeah. You know, me personally, I'm okay with not adding
I mean,
it.
I would think if somebody was asking about one of one, if he was talking to somebody or even talking to us, create his own blend.
Yeah, that's right. Okay, well,
And maybe, and I will, what I can do is, I'll mention that to Marshall to pass along to the representative that goes out there, that if somebody says, hey, I'd like to think about this, you know, cool,
How about Julie?
here's a way to do, yeah, Julie,
Yeah.
say, here, cool, here's what you can do.
right,
If that's, you know, if it's an area you want to tap into.
yeah.
Not to, you know, not to make you do all this work, Freddie, and then,
Oh, no,
you know.
It's what I do, but, you know, if you go to page 25, just as a point of interest, you got small value, 1.6%.
Which one are you looking at here?
Yeah, page 25.
The small value is 1.96%.
Yeah, 1.96%.
And small value.
Small value, and then small growth is 1.8.
Yeah, so across the
Rated on
pan,
value anyway, which is.
Yeah.
Be.
so, okay. I'm not even sure that a motion has to be made one way or the other on this.
I don't think so.
Okay. Let the minutes reflect that consideration was given and passed at the time. Okay, so for administrative matters, on the subject of QDIA, Qualified Default Investment Alternative. And I'll just kind of reframe this concept, and I didn't include this, but I can certainly send it, but I'll just highlight a paragraph, and this is the, this is not in, I did not include this, but, so, what is QDIA and safe harboring? And technically, the Q, qualified, kind of doesn't really play here in the government space, but it's more a default investment alternative. We want to play by the same ERISA guidelines, you know, act like an ERISA government plan for, you know, best execution. It says that the Pension Protection Act, PPA, offered a number of incentives for plan sponsors to adopt automatic enrollment features into their retirement plans. One of the most significant being the safe harbor provision on QDIA. It says provision protects plan sponsors, that's you guys, when selecting default investments on behalf of employees who neglect to make an investment election of their own. Historically, selecting investment options for employee contributions has been a decision fraught with fiduciary liability concerns. The creation of the safe harbor to protect the employer from fiduciary liability resulting in these decisions is a welcome change. So this is part of the Pension Protection Act. And so when we set up the investment policy statement, and I raised the issue that, okay, you need to identify what the default investment options are. And historically, they've been anywhere from a money market fund to a balanced fund. One fund is like 60 stock, 60 stock, 40 bonds. They can be targeted funds. They're the most prevalent now in today's, today's day and age. They can also be the managed accounts. So we made them, the default funds, the targeted funds. List them as such in the investment policy statement across Mass Mutual, ICMA, and Nationwide. It's been my experience that the QDIAs, the election at the plan sponsor level, has been done and already in place on the side of the record keeper, Mass Mutual, ICMA, and Nationwide. And it occurred to me that I was not aware of that actually happening, because this is kind of a new concept. So I spoke with Mass, ICMA, and Nationwide, and I got different answers, but I had the fix for all of them. So with Mass Mutual, when this Protection Act came out, no action was taken, and the plan sponsor, no fault of yours, probably nobody just raised your awareness of this. Mass Mutual, in their mode of operation between the record keeper and plan sponsor, never came forth and said, based on this Pension Protection Act, here's what we would recommend you do to address this. So it was never set up, ever. Now with Nationwide, it was set up. And for the longest time, on the Nationwide side, the default election was the Dreyfus money market, which we're going to address also, the money market reform. And in ICMA, to their credit, I spoke with Sean Baker about this, they came out this time and they communicated to all their plan sponsor clients, some of which may not have even acknowledged this, but it was done by negative election, where ICMA made the decision to, by negative consent, make target date funds the default election. So therefore, there's no action that needs to be taken with ICMA. So they're out of the picture. Now we're going to address Mass Mutual and Nationwide. So I've included letters in speaking with, and they're in your packet. And so, and this can be, I can send this to Vince Moore. He can pop this on city letterhead, whatever the case may be. And so, to Mass Mutual, default fund election. Dear Mass Mutual, for the City of Las Vegas 457B, 401A deferred compensation plans, please accept this letter as a request and authorization for the election of T. Rowe Price retirement date funds as default funds. In any instance where a deferred compensation plan participant does not make an election for all or part of their plan investment allocation, please use the attached table to select the age-appropriate T. Rowe Price retirement fund as a default investment option. Please initiate and update any required participant communication and/or disclosures associated with this fund election. Now, the enclosed table is in reference to this that will be included as an attachment, and this is T. Rowe Price's table of, based on your age, what fund you would go into. And so what it really comes down to, I guess in a highly, highly unusual case, you know, not to say record-keeping mistakes don't happen, quirky, fluky things could happen if somebody elected to participate at a 5%, 6% deferral rate and didn't turn in an investment allocation, then Mass Mutual has the authorization direction to put them into an age-appropriate date, and as a plan sponsor, you enjoy safe harbor from any liability in this process. Another, in probably a more frequent situation, is somebody elected 6% deferral rate, fills out an investment allocation, and only ends up to 90%. Didn't do their math right. Then that's the last 10% would go into the age-appropriate targeted fund.
I guess I'm wondering, since these forms have to be submitted, can't this all be resolved by the person they're submitting it to prior to it going to ICMA or Mass Mutual? Well, I mean, we're a big organization. We're not like 400,000 employees or something where...
You talking about at the participant level?
Yeah, when you have to participate, you have to fill out that form. When it goes to HR, the person it goes to could do
A check?
yeah.
Well, they could, but what if they miss it? This is all for your protection. So there's no,
The answer to your question is we should be doing it anyway, but you still have some fallback.
Well, the fallback would be call the participant and say, what do you want to participate in? Here's your form back and fill it out correctly.
Well-
Well, you got to put the contributions someplace.
yeah, and excuse me, that's a good point, John, and that's kind of how it has been going. But it's more layers of administration, of rundown. Mass Mutual has to call somebody at the city has to chase down the participant. You know, it's a lot of.
No, I understand. That's why they're paid a management fee to do it.
Well, let me just say this, I think whatever we can do to minimize our risk for, participants, erroneous form is
Right.
worthwhile.
Right.
Separate from that, so I think my personally, we need to do something.
Yeah, no,
But separate of that, I get your point, there ought to be an administrative process that keeps it to a bare minimum.
Are we finding like
But
there's
in
a
my
lot of
head,
this?
but in my head, I don't
Are we
even
finding there's a
know.
lot of this?
That's
mean,
what I was
like,
just
are
gonna
we
say.
like a-
In my-
like
Are we
in my
killing-
head, I don't know.
Are we?
how
Yeah,
to
are we killing a fly with a
I don't think so.
sledgehammer
Well,
here?
Not even close.
I mean, I would think it would be a pretty minimal number. that
5
we're
or
talking-
less, 5% or less.
That
I
we're
would
talking,
hope.
they can't add up to
Probably less
100%.
than that. I bet it's even less than that.
I bet it's even less than that. But the point of it is that the Department of Labor is giving you some fiduciary protection in that rare instance. Take,
Yep.
Yeah.
but it has to be done properly. is
Yeah, that
the way
makes
to do
sense.
it. So.
I mean, I guess if all the
so-
balls are dropped along the way, it's better they're in something that's reasonable and they're not going to come back to us and say, you cost me 10% growth or something.
Well, that's true, but the next part of that is that, let's suppose that 10%
Is it a
goes into
negative?
something, and then the participant says, well, but I didn't want it in that something.
I would almost put it in a money market until they fix it.
Well, there you
Well, the thing is, it has to be done, but again, when they fix it, then there's a whole nother layer of administration, so,
What, do you go on a website and you click move money market to,
but the participant isn't aware of it anyway, because if they made the mistake in the first place.
no, but when it gets caught,
Yeah. Well, it could, but the point is.
well, you're saying, I mean, at some point it's going to get caught, right? Am I giving too much credit to the people who process this paperwork and to Mass Mutual and to ICMA and Nationwide?
No, but,
Jennifer's laughing down at the end of the
I'm
table.
smiling.
go. Can I ask you, the HR rep, to circle back with Vince on this subject? I'd like to know, maybe just to report back next time, how often this even happens, and what we do internally when we process the application to minimize that. Because it's still a valid question. I still think we need.
I like to target date funds, and that's the appropriate thing to
Yeah.
be in. I'm just wondering.
Well, then my other question is, do we even process them? HR. I don't think that we do anymore. I
Some
think-
of them, but not,
I think that most of them you have
everybody
to do
goes
it
online
yourself.
and do it themselves. We're
Because they're
trying
being
to
directed,
automate
they're being directed
that.
to do it online
Yes.
themselves.
Oh, to participate, to commence participation?
Yes.
Yes,
less paper.
less paper. We're
Yeah,
trying
but
to-
However-
every time I
however,
change
the
my
ones-
deferral,
however,
it's
the
a
ones
big
online-
friggin'
Makes me
pro-
count up to 100.
However,
For
the
one
ones
second.
online usually have their own validation that says, hey.
Yeah, you don't
didn't
add up. Yeah.
Right.
Right.
But the initial startup has to be on paper, right? To start.
No, they just go and they log in to they set an account.
I know, but how do you,
themselves.
the automatic payroll
It's
deduction?
in there too, and it goes, and there's a report that goes over to HR and they forward it to payroll.
It's a data feed.
Well, when did this change? Because,
Within the last 6 months.
oh, okay.
Yeah, that's why I'm saying.
Most
if
of
you
our
have
stuff
to-
is on
If you have to
here.
go,
Okay.
if you have
Oh,
to
that's
go
good.
online,
I know,
and
but-
they're not processing it at all downstairs.
We are on a minimal level now, for those that don't have access to a computer.
Yeah, and if you're on the computer and you have to add up to 100% and you don't, you're probably not going to get to the next page.
This one's-
You know,
That's
yeah,
correct.
And
but-
then you close it out.
Yeah, but all those, everything that's been mentioned is valid, makes sense. But
This is belt and
So
suspenders.
does everybody in the whole, each plan have to sign one of these?
Well, no, Rusty, it
Or
was
is it just
never
a
set up,
room?
it was never, oh, no, participants don't sign this.
Oh, this is-
Oh, this has nothing to do with
This
participants.
is between the sponsor and
The record keeper.
And the record keeper.
Yeah.
Oh, okay.
Yeah, I'm sorry, I should have made that clear. Yeah, so this is, outside. However, there'll be disclosures on enrollment and website of the QDI.
Right.
Yeah.
So, can I make this easier for us? So,
Yeah.
we have target date funds in all plans.
Right.
And it sounds like that your recommendation should clearly, apparently, seems to be the industry preference, that those become the designated
The target
target date.
date. And they're in the IPS as such.
And so,
Then I have a question.
Yeah.
If that happens,
Yeah.
if someone doesn't add up to 100%, are they going to be notified that this election has been made for you because your allocations didn't add up to 100%?
Well, it's in the disclosures for the plan, and then their first statement's going to reflect it when they get a statement.
Okay.
I don't think
Yeah.
it lets you go past that though if you don't have it up to 100%. And when you do it online, I don't think you can get past
I
that.
can't imagine it would.
No.
Usually, it might be different for each record keeper, but
I mean, I'm just asking,
Absolutely.
I'm just asking if, basically, if we do this right here, and it happens.
what I'm saying, well, we're saying two different things, though. What you're saying is, whatever happens today and has happened in the past, whether they got a notice or not, the money's got to be designated somewhere.
That's
It's got to go
right.
somewhere. And all we're doing today is trying to figure out where is that somewhere officially. The notice piece is, and I think, I'm pretty sure Freddie's right, the notice piece is probably unique to each record keeper. And maybe that's another question you can add to the list of events that we need to check with the record keeper to say, when
A default election
contributions haven't been
should get
designated and
a
you
tickler.
default them, do you just assume that this person who can't add up to 100 also looks at his first statement? Or do you give them a notice, Because if they can't add up to 100, they're probably not even looking at the statement.
Well, that's where my point.
Maybe
Yeah.
we could have HR or Freddie, but I'm asking HR to kind of look at those two things. How much of a problem is this in the past, and how much is it today? It may not be any problem today, the last 6 months, if it's a lot of it, that'd be great. But meanwhile, it seems to make sense to me that we would designate these anyway in the plan as a default, and in any event it ever happens.
Yeah.
Right.
I mean.
That makes sense.
If we change the record keeper somewhere down the road to somebody who didn't have an automated system, which seems highly unlikely, it could happen again. So I think it's made sense. So do you want, how about if we make a motion and vote on a motion to make that the designation for all the plans? At least it even covers ICMA, even though they're doing it, we never as a plan sponsor told them to do it.
right.
They just did it.
It was done proactively on their part. And again, I'll remind you that in our investment policy statement, plan sponsor level, the decision has already been made to make the target date funds the default collective offerings. What we're talking about here is tying up a loose end, making sure the record keepers acknowledge as such, having the proper documentation paperwork so that they can execute it on their end.
And part of my reason for sending the letter to ICMA, even though we've already done it, is to sort of put them on notice that you need direction from us, you just can't decide for us.
Okay.
That's part of the
Okay.
other thought.
Yeah, I think they need
That's
to have
kind
a
of
letter
right
as
now.
well.
Yeah, I would give them
Okay.
a letter as well, maybe it
That's
says
good.
something
Good
good,
idea.
it says, by the way, we appreciate what you did, but you need, this is our decision.
Okay.
Makes sense.
So, blah, 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 that's my motion, all that stuff I said, that we would designate that the target date funds would be our default under the QDI protection. And we would send letters to each of the plan, our record keepers designating those as such. And as an aside, not part of the motion, but we're going to have HR to see what's been the performance in the past, what happens today, does it even happen today, is it even possible to happen today, just so we have a little background. And then what the record keeper does in terms of notice that they have to notify, I can do that for the next.
Okay, And then last detail on this QDIA. So now, again, on nationwide, Rusty.
Yeah, that's a question I was going to ask
Yeah,
you.
so back at some point in the past, and I spoke with the administrators at Nationwide, Michelle Swayer, very helpful. The election was made one way or the other, and I don't know if it was proactive in the city or by some end of election at Nationwide, but the driver's money market was set up as the QDIA. So the letter to Nationwide, please change the default investment option from the driver's cash money market fund to low price retirement date funds using the same table, initiate any required participant communication disclosures associated with this election. And the same zero price table will be used. And I actually front ran this with Michelle, got the language they're going to want to accept it, and that's what this letter is. Okay, next item.
So,
wait a
tell
second.
me, before you move forward.
Yeah.
So, because this is mostly police and fire, or excuse me, fire, so as an example here, you have, currently there's only just short of $350,000 in that Dreyfus.
Well, we're not talking about that,
Dreyfus, yeah.
We're not talking about the money market formula. We're talking about any elections that aren't made
Going
into a
forward.
fund.
Going forward.
Yeah,
This is a go forward.
yeah.
Okay.
We're not on that agenda item just yet.
Okay, well,
Um,
just trying to
Yeah.
figure this out, because.
Yeah, so there's two separate issues. Number one, the QDI election nationwide, we're going to change from the Dreyfus money market fund to the target date funds going forward.
And that was my motion.
That being said, I still don't like these dates here, because they don't match really what we do. That's not us. Like for me, this would target my money, this would put money for me into 2025. I'm not going to be here in 2025, just so you know. I'm just, fair warning, I'm not going to be with the city in 2025.
Might your money still be in the plan though?
Maybe, maybe not.
Well, if it's not in the plan, then it doesn't matter.
Doesn't matter.
But if it is in the plan, I guess the question,
It's going to be invested much
It's really-
differently on a 2025 as opposed to if it was something else.
it's really a good question. The question that we have is on early retirees.
Right.
We talked about this earlier and we never came up with a
These are
solution
folks
because
that
we're just using
typically-
stock plans that
these
don't
are-
match our retirement.
Yeah, these
Yeah.
are folks that typically retire possibly in their late 40s, but certainly a lot in the 50s and the 60s. So there isn't a target date plan that I know of
There isn't.
for early retirees.
No, there isn't.
And
Well,
so,
yeah.
and so I don't know what you would do.
Well, here's what I can
Well,
do.
see, because so when a kid signs up now, he may not sign up for the target date plan that matches this date of birth. He's going to look and say, I may be 25 years old, and I'm going to retire in 25 years, which puts me in this target fund. So he's not basing it on when he was born. He's basing it on how many years he's going to work for the department
Right.
or for the city.
Yeah.
I'm going to work 25 or I'm going to work 30, so he can plan that out based on the years of service, not on his age.
Yeah.
That's
So they
the
still
point.
match.
But all we're talking
Yeah.
about here is a default going
Right.
forward.
So I mean,
To
understand,
something
we're
that rarely, if ever, is going to happen going forward. So
on a default, yeah, okay.
Let's not
I mean,
kill it to death.
But, it's an interesting point that, if you look at the city of employees as a whole, and you carve out the firefighters, and you would know that you're adamant that they have a different, a more unique timetable than the non-fire, right? So, it's possible that I could, put some work into, well, first of all, let's suppose so not the QDI situation, because that's not going to be affected, that this plan doesn't mention. But let's suppose a new firefighter's enrolling, and he's with Julie Miramontes. And Julie's talking about the targeted funds, the company ways to be in it, the firefighter likes the idea of it. Then Julie, from a consultative point of view, education point of view, knowing the firefighters have a different timetable, ratchet them down 1 year, or one series, 5 years, into, you know, the fund that, you know, puts them at retiring earlier. So that, you know.
Yeah, I mean, these are based on the concept that you're going to retire at age 65.
Right.
And our guys don't stay till 65.
In some businesses are.
Not all of
Stay
them.
till 65, I mean, it depends on when they started.
I'm not quite there yet.
Well, here's the
I'm 10
thing.
years short of that.
And this is a good conversation, but you know, is it maybe being overthought? Because again, if you're in a retirement fund based on age 65 and you retire at 60, well, the equity exposure probably isn't going to be that much different. And if you stay in if you're going to keep your money in the plan, even at retirement, it's still going to be managed with the glide path, with equity exposure to help you not to be subject to that longevity risk. And if you leave the plan, pull your money out of the plan anyway, and put it with a financial advisor or an IRA or whatever, then it's moot point anyway. So, you know, it's good conversation, but
And again, this is only about the go forward occurrence where someone fails to add up to 100, if that's even possible in today's enrollments. It's just, all we're doing is availing ourselves of this election that gives us protection. So I still think it's an easy vote.
Yeah.
We may need to go back. I do think Rusty's discussion about, given that the public sector might be slightly different, maybe there's an education component of this, as Freddie's talking about. When people are signing up, if they're talking to one of the consultants, one of the advisors, that make sure the advisor, because sometimes we hire people and they don't have a clue. They might have had all kinds of public service in another Nevada entity. So, yeah, I think that the advisor might get different advice. They do that.
Well,
I assume they do.
You know, and it doesn't happen often, but there are times when we'll hire somebody who's advanced in age. So if you were to follow this chart, they would be in a 2000 whatever fund, but they really are only going to work for us for maybe 10 years. We've had one guy retire at age 60. He started when he was 50. So if he'd enrolled in the targeted funds, but picked one based on, you know, I don't know.
I guess the question is, and I don't know the answer to this, but what we've been talking about here is when we think about the target date funds, is that glide path more an issue of longevity of your lifespan, or is it issue more of working income versus needing a stable income for retirement? I don't know.
well, that question is right in the heart of the picking this type of targeted funds, whether it's a 2 or a 3. So, you know, somebody that isn't as financially sound, something maybe in the gaming industry, that, you know, low average account balances, no deferred comp plan to fall back on. The consensus in that environment is that you should have a 2 glide path with less equity exposure, because they can't take the volatility risk at retirement. For the city, it's different.
PERS.
PERS.
PERS is a big piece of why you can take a little more risk.
Exactly. And so more equity exposure, because you don't want to face the longevity risk of not getting the growth enough to run out, you're going to outlive your money. And that goes back to the whole analysis we did to identify.
Can I restate my motion or not? Julie's got a question? A statement?
Yeah, I have one question. I would like we're asking you to write, in this motion, we're asking you to do a letter for IMCA.
I see it again.
It would be signed by the city, not by.
Right, I'm just asking, because he's putting letters together.
Right,
I'm
but we
just
can add
asking-
to it.
I'm just asking if he'll please send the committee a sample of that letter that we're gonna send to him.
Yes.
That's all.
Yeah,
Oh, I got you.
Yeah.
Like the one for ICMA.
Yes.
yeah. And in basic, there's just
It would be more of an affirmation that we agree with reallocation,
Yeah.
to your designation for, but remind you that future these sorts of elections, we choose to make affirmatively as to negatively.
makes sense.
They were trying to protect us, I get that, but
Right.
it would have been nicer if they would have asked us. If they would have asked us, maybe we would have figured out we should do something.
Okay, good enough.
All right.
Uh,
Good point. All right, got it. All right, so I made a motion. Anybody want a second?
Second.
That's all in favor, say aye.
Aye.
Opposed? Okay. All right, let's talk about the thing everyone.
Okay, well, not yet.
No, you
Administrative item number 2, targeted fund enhancements. So, originally when target date funds kind of came into vogue, circa 2002, 2003, every 10 years was the standard for target date funds. At some point, plan sponsors would start using every 5 years. And so we have different configurations across our 3 record keepers, and I'd like to propose that we standardize them and include every 5 years, and have the record keepers reallocate, based on that chart. And again, I front run this with them. So if you look at the Mass Mutual letter again, the bottom letter is regarding T. Rowe Price retirement. This is the Mass Mutual. Now, Mass Mutual, had the State Street Global Advisor index target date funds every 10 years. And they were terrible ranking. They were 2. We replaced them. We mapped those into T. Rowe Price retirement date funds in the years that were already represented, mapped into the T. Rowe Price retirement date funds. So your Mass Mutual, for the 457 and 408 plans, we are requesting the below items as enhancements to the current T. Rowe Price retirement date fund lineup. Please add retirement date funds 2020, 2030, 2040, 2050. With the addition, we will now have the 2015, 20, 25, 30, 35, 40, 45, 50, 55, 60. Number 2, please reallocate and map all participant account balances currently in T. Rowe Price retirement funds using the attached table. Yep. Initiate any communication associated with this. So what you have here is, I don't know who could argue that every 10 years is acceptable, but if you add the 5-year gaps and reallocate, it's all the more precise. At least, that's my thought process. And, Mass Mutual, boy, we've never heard of that. Well, you have now. It just makes sense. So, Mass Mutual hasn't been the most proactive in recommending certain things, but they think it makes sense, and they can certainly accommodate. So, any questions or comments, or does anybody think of a reason why this shouldn't be done?
I can't think of any reason why not.
And so the the ticker symbols represented are the ones that adding the new funds every 5 years with the same share classes, expense ratio profile as the funds already in the lineup.
Do we need to make a motion for that?
It wouldn't hurt. I don't think there's any.
Yeah,
so
make a
I make a
motion
motion
that
on
we
this.
formally ask in the letter as described Mass Beach add the 2020, 2030, 2040, 2050 target funds into our lineup.
Second.
All in favor, say aye.
Aye.
Opposed? None.
Okay, very good.
Now practice.
Not quite. So,
Oh,
in the target date funds, in the target date funds, ICMA has had every 5 years. Nationwide, the target date funds were not in the lineup. We added them to the lineup, and we funded those target date funds from the asset allocation funds, if everybody remembers. We keep going with that, back to that. And so, kind of consistent with the Mass Mutual and in certain extent adding the T-Row price funds, which were consistent across Nationwide and Mass Mutual. We had initially used every 10 years, served the purpose at the time, but now another revision, another refinement, same thing.
I'll make a motion to send a letter to Nationwide to add 2025, 2035, 2045, 2055, which I think will actually be helpful for you guys because the times are shorter periods of time. So add those funds to the line.
I'll second that.
All in favor, say aye.
Aye.
Opposed? Anything else I screwed up? Now it's
Let's talk about money market reform. So, I showed this last quarter, but to get everybody kind of refocused visually, I included this piece again because it's kind of the framework. So the SEC has been working on this for some time, and it's actually going to go live October 14th, where there's a money market reform around different types of money markets. And the concern is that if something happened like in 08, 09, when people even want to liquidate their money market funds, which they thought is always rock solid at $1 net asset value in and out every which way, dollar in, dollar out, whatever yield you get along the way, that's great. That if there's a run on the fund, what's going to happen to that fund is going to hold up if it really maintained $1 per share, and what would the liquidity implications be. So as you can see here, for money market funds that are classified as institutional prime money market fund, which in fact the Dreyfus is, and we're talking for ICMA and Nationwide, and each of those record keepers has very different implications that I'll describe to you in a minute. So that if you're going to, after October 14th, if I'm in the Dreyfus money market and I'm going to redeem shares, I might not get $1 in. The NAV, the net asset value, is going to float as represented by the assets, the bonds, whatever, be it investments inside the fund, mark to market every day. What is the value of those going to be based on credit spreads, contracting or widening, or short-term rates going up or down? How is that going to affect the underlying value of those securities on a daily basis? So if I'm a participant and I thought my money was rock solid, safe, $1 in, $1 out, and I go to redeem and I get 98 cents, just in principle, it's not good. The other thing is that the investment boards of these funds, you see that there'll be liquidity fees imposed. That's also not cool. And And then if that's not bad enough, is that if there is a run on the fund and the board may suspend redemptions, and you have to get in line at the redemption gate if the liquid assets in 10 days falls below 30%. So that's why a decision has to be made with this fund. Now, we'll come back to this as needed, but if you reference the Dreyfus piece there. So down in the second, below the second gray bar, the Dreyfus Cash Management, the fund right there. You see what's held in it, but the point is that this is a fund below the boxes, institutional prime funds. This is in fact an institutional prime fund. So for any participant that's in it is going to be met with upon redemption of floating NAV, redemption fees, and may have to get in line. May have to get in line and wait until they can get out of the fund. So the whole game is changing here. So what plan sponsors are generally doing, and what your real viable options are, and they have, like I said, they have different implications for ICMA and nationwide. So then you have to realize that because short-term yields are so low, if you're in this prime money market fund, net of the operating expenses, the yield is zero. So for these people in ICMA, 16 people that have been in this money market fund, they probably are in it not knowing that they could have been getting 3.3% in the nationwide general account as a cash alternative. But somebody said, oh, money markets are safe, and it is and has been, and they're probably in it not even knowing that they're getting zero yield. So I could search for a government money market fund, which, government securities are going to yield, not that you can get yield less than zero, but zero is zero. But even if short-term rates go up, the government money market funds will yield less than the prime funds. So with ICMA, what I believe a good consideration would be is just to simply, make the election at the plan sponsor level and we would do it in time so that ICMA could put out the 30-day notice in time to make any change by October 14th. It's just simply take these assets and map it into their stable value fund, which is highly liquid, in and out, and it yields much more than, and this be done with the Dreyfus money market. Close it, get it out of the plan, never look back. Because you're not giving up anything by not being in it, but you're picking up yield and being in the stable value fund, in the Vantage Plus Trust Fund, that's an ICMA. And to me, that's a no-brainer. We can get back to that, but now let's talk about nationwide. And this is very, very important now. And I think we're all going to be enlightened into what really is in these these general account stable value funds. And we all know about the polarizing case of Mass Mutual yielding 4%. And Mass Mutual isn't even an issue with money market funds because there is no money market in Mass Mutual. But with Nationwide, they have a very attractive general account. It yields 3.3%. It's not 4 like Mass, but it's still a very attractive yield. The problem is that if you look on Nationwide's enrollment form, and go to page 4. Go to nationwide fixed account. Item number 3. Exchanges. Now this is if you're in the nationwide fixed account, the general account that yields 3.3%, which is a great deal. Exchanges or transfers may be made based on one of the following options as chosen by your plan sponsor. At some point in the past, Las Vegas chose option A. Exchanges and or transfers of money market from fixed account may be made no more than twice a year and may not exceed 20% of the fixed account value. Once the 20% limit has been reached, no further exchanges, transfers will be permitted out of my fixed account during the remainder of the calendar year. If my fixed account value is less than $1,000, I can exchange the entire account value. So they're waiving it less than or equal to $1,000. Exchanges, transfers will count towards the limitation of 2 exchanges, transfers out of the fixed account per year. Additionally, a 5-year exchange transfer election allows the systematic movement of 100% of the account out of the fixed account on a monthly basis over a 5-year period. If elected, you cannot defer exchange or transfer out of the fixed account during the 5-year term without canceling. And what that means is, again, you think of the various scenarios that could be out there. One scenario, that I considered, let's just say, at some point, if I'm a participant and I've been a city employee, a firefighter for 15 years, and somebody I trusted, an advisor, a friend, whatever, got in my head and said, well, you shouldn't really take any risk with your retirement. That should be safe. And we know that's not really, that's what you need to really kind of try to grow, But we know the other side of that story. You should keep that safe. So somebody put 100% of their account in the fixed fund, earning 3.3%, which is good. Can't really retire on it, but it's a good rate of fixed. I have 100%. And all of a sudden, I'm 50 years old and going to retire in 60, whatever the case may be, firefighter, maybe it's different, start 40, going to go to 50, 55, whatever. And now I do get connected with a financial advisor that I do trust, runs, models out cash flow and says, well, it's good that you're saving, but if you really want to retire or meet your goals, you can't do it on 3.3%. You need to be making 7%. And in doing that, I think you should take on an allocation of 70 stock, 30 bonds, which could mean roll out, put 70% into the, it's going to be the global, put 70% in the global stock fund for simplicity, 30% of the Western Core Plus bond fund for that allocation. It would take you 5 years to roll out of that fixed account to take on that allocation. So again, it kind of goes back to day 1, whenever that day was, that you take on this general account, you don't really know what you're getting or what implications, and now come to find that you have to deal with this. Now, option 2, or B, is that the city could have elected and can still change the election if they want to, as I come to find. Exchanges or transfers from the fixed can be made, 100% of the account value. The total of all participant exchanges and or transfers should not exceed 12% of the year. So if it's July, and again, I had that same scenario where I want to get out of my money in the general account, and for some reason, 12% of the balance of the fixed account by the city of Las Vegas has already been redeemed, then I have to wait until January the next year to get back to accomplish that. So I point this out by saying, if you're in the fixed account, you're getting 3.3%, you're happy with it, that's great. The idea to now move the Dreyfus Money Market Fund into this is a more complicated decision than what we just faced with ICMA. And I think in this situation, you either keep the nationwide general account and change the constraint to option B, that I think would be probably more user-friendly or less constrictive on a participant, or keep a money market, select a government money market, knowing you're going to get zero, if very little yield, and still give people that safe, haven of being in something that, money market that isn't going to be subject to floating NAV, redemption fees, or redemption gates.
My, if I had to choose between the two, I would ask the city to keep the fixed account, nationwide fixed account, but change option B. Here's one of the reasons why I would look at that. Certainly, you want to try and protect people from, bumping their money around, but they already have limits on the number of, trades you can do a year, or move you can do a year.
Right.
When the market was dumping, I know people who took their money and moved it from some of the more high, the equity stuff, and moved it out and put it in their safe, put it in the fixed account.
Mm-hmm.
Then when things settled out, they tried to move it back out 20% at a time.
Oh, so you are aware of that?
And you
You have been, okay.
You can't move it out more than a certain amount per year. So if you moved a bunch of your assets over here,
Mhm.
you can't move it back out to put it back in. And I guys say, hey, what if we do? Nothing. So if the city chose to do that, that would give guys, give people, I guess, another option. Certainly, you wouldn't want them to be moving their money all over the place all the time, but there's already limits on how much they can do that.
Yeah, so, interesting dilemma.
To apply, let's assume, what do we got, 22 nationwide? And I think it was 22 people.
And that's only for those that are in the Draper plan now, but I'm just saying,
Let's just
Yeah.
say, well, let's-
this addresses another issue,
That's right.
but it's deals with the same thing with the
Yeah,
fixed
you've got-
account.
Yeah, you've got, essentially what you've got is 5 million.
Oh.
And the nationwide account.
Right.
And the fixed account.
Rusty, you're proposing, just so I understand, to address the money market reform, so people in the money market are not subject to those floating NAVs, redemption fees, and gates. Move the money into the general account, but then change from option A to B, to where in theory it would be less restricted to a participant that wanted to roll out of the general account.
Yeah, well, and especially because they don't know, out of that $350,000 that's there, and you said there's, what did you say, 21 participants that have that money in there, I think, you said something like that. How close are they? Because, and you said a lot of them are in the 401A with that money. So the bottom line is, those people are probably either in administration getting ready to retire, or have already retired and deferred some money into their 401A before they left. So, you wouldn't want to take away the ability, especially if they're already retired, the ability to take that money out of there if they wanted to.
Right.
But if you change the other over here, then they'd still be able to access it without having to worry about it.
Right. If for some reason
At
it
least
was,
theoretically, 1/12 of them.
if they want to be in the one, if there
1/12
is
of them could access
exodus,
it and take
yeah,
it all, so to
Yeah,
speak.
that's right.
If they all had equal balances.
Yeah, in a calendar year. If there's some exodus out of that fund, you want to be in the first 12%, otherwise you got to wait till January of the following year.
12%, like $500,000.
I don't know what your thoughts are.
Is there any other option?
Well,
could we?
They're not not making money with Dreyfus anyway, but
We don't have a stable value fund here because we use the nationwide fixed account. Could you add a stable value fund? Without screwing up
No, that's gonna be what's called a competing
Yeah,
fund.
there you go.
Yeah, and that's a no-no. I guess in theory, you could take the Dreyfus Cash Money Market and map it into age-appropriate target date fund. But then you're going from what's a
That
cash
makes me a
out,
little bit nervous when if these people are in money market at the beginning,
Right.
they're obviously risk averse.
it's a cash alternative, you're going to a whole other risk category.
a lot of them are retired.
Yeah.
Some of those guys that are in that 401A, I'm sure that they deferred some of that money that they rolled in the 401A, they just put in that.
Okay,
You might be right.
and
So then
so,
you put them in a target date fund, they're already retired.
yeah.
Doesn't make much
What's the
sense.
dilemma?
Yeah. Like I said, to me, I think the only viable option for the nationwide case is put them in a government money market fund that is going to deal,
Let me ask
or
you, another stupid question with these. 22 people.
26 people in
26
nationwide.
people, whatever it was. Let's say it's 26 people, so could we communicate to them just those 26, the issue? So that they're aware that there could be a problem if they stayed in Dreyfus, there could be a problem down the road.
Mhm.
We can't predict it, it's not predictable, but, we can't predict we won't have another event like we had in '08. So could we leave it there, give them notice, and give them an option? Or at least let them decide where they want to move that money to?
Well, you could. I mean, nobody's making, DOOs are making plan sponsors
Yeah.
get out of the fund. They just want to let people know
It
what.
says, the last action step here is
Yeah.
prepare communications to participants explaining what the potential impact is. And maybe that's all we do with these, because these guys are in a different situation. To put, to dump the 700,000 and the 4.6 million
Oh,
is.
no, excuse me, Mark.
I'm sorry, no,
700,000.
348
Yeah,
and
348.
4.6,
Yeah.
4.6 million. You're still gonna have this 12% limitation, that once total of 12% is hit, the other guys are gonna be blocked out until.
Yeah, that's not good either.
And that's not gonna be pleasing if
You're not the-
13th percent back.
Yeah.
And so
No,
I'm
that's true.
thinking that maybe what you do for these guys is you send a unique letter to 26 of them, notifying them of what the risk is of their inability to get their money market money out in the event of some unforeseen
And allow them to
crisis.
just transfer it themselves,
And-
until they
and just-
advise them to transfer it
Yeah,
themselves.
and say, if you're uncomfortable with this, there are, you should look at other fund selections or consult with your advisor to make other fund selections. We might have to tell them about the nationwide fixed account. I'm not saying don't change it to the other one, that's not what I'm saying.
Well,
I'm just saying, the change
looking,
to the B might be okay too. It's just that I hate to move it for these guys without them understanding that we're trading a future unknown problem to a problem that's a little more clearly defined. Once you hit 12, it's done.
And looking at the two options here, A and B, and when you look at that, you do say 12% per month,
It says,
12% per year of the
total
total amount, so
of all can't exceed 12%.
that certainly limits drastically people taking money out of there. I think that's probably not a good option. Like you said, if you're under 13, 14, 15%,
Gotta wait till January of the next year.
Well,
That
the
would be
next
good.
10%, Ken, so it still takes 5 years to get all, it'll take 10 years
Yeah.
or 8 years for all of them to move out if they wanted to, it'd be some orderly progression, so.
yeah.
Yeah.
We'll probably better stick with what we have and try and find an alternative for the money that.
Either find an alternative or we communicate specifically with them that to advise them of the risk, because that's really what the recommendation is ultimately, is at least let them know that if you stay in the breakfast money market account, you're gonna, under certain circumstances, you may not be able to get your money out or get it out 100%.
Well, so,
And that's why I was asking about adding a stable value fund, because you're not gonna be able to compete with the nationwide
Right.
fixed account, so you,
Right.
I don't know if there's something else that's close to a stable value fund, but even then,
well, the thing is, the closest thing you could add is going into a higher risk category. There's no way around it. So again, if somebody's in the money market fund or the fixed account, first of all, whoever the 26 people, like I said, they're probably oblivious to the fact that they're earning 0 and just not aware that they could be in something earning 3.3. Because most people probably aren't even mindful of the
but
restrictions.
even if they were aware of it, they're certainly not aware that at some point, if we have another event like 2008, they may not be able to get their darn money out.
That's
That
true.
would be a shock to them.
That's true. They could get less money, they could be imposed fees, or have to wait. And so, if you send a communication to some 26 people, it's likely that maybe only half of them will read it. Hard to say, but the other consideration is to send the notice of what could happen if they stay. And because of that, the committee's making the decision to do something for you and to protect them from the, you have to pick your,
My problem is they just know what the something is.
Yeah.
That's any better than where they're at now.
well, the thing is, you have to pick your poison. So do you give an opportunity to stay
What I'm
in?
saying, Freddie, is I don't have to pick a poison, I just have to communicate with participants. That's really done. Whatever, minimally, I have to notify them that
True.
the rules are changing, this could be an issue for you.
That is correct. But then,
And the issue you brought up about, maybe they don't read the notice, maybe since it's only 26 people, maybe we ask Julie to follow up with a call.
okay.
Have Julie make a phone call.
But, and again, let's talk about two things. The requirement is to communicate, and that's going to be done no matter what. Prudent man rule, if a participant is not mindful or doesn't know every detail to make an informed decision to protect himself, the committee's obligated to do that for him. So if you're a participant in that money market account, if it's your money, what would you rather pick as the least invasive option is to redeem your shares and get either less than you put in, have a redemption fee or have to wait, versus getting 0 yield, going to something that's yielding 3.3, and then being constrained by the liquidity. You're still going to be dollar in, dollar out, but still be constrained by the liquidity, by the redemption provisions coming out of that. So therein lies, the quandary. Well, Rusty, this is nationwide,
Rusty
it's wide
does.
over there.
I think Mark's idea of contacting each of there's only 26 of them,
Right.
letting them know what the ramifications are of staying in this fund, and offer them the opportunity to, move their money to something else. They may choose just to move it into, some other fund, or like I said, if they want to move into the stable account, they can. Chances are, if they move into the stable account, they've already got money there anyway. Chances are, because there's only $350,000 there, there's $5 million in the stable fund. So the chances are they probably already have some money in the stable account anyway, I
Okay,
would think.
okay.
So they have the option, let them know what their options are. You move it into a different fund, or you can move it into a stable fund. But it's probably in your best interest to move it out of the Dreyfus
Okay.
money market fund.
Okay, so it's I think it's a two-pronged attack. That it's one thing to have Julie talk to people and tell them, and that might be effective, but I think there has to be some documentation, a paper trail
I
of
think-
communication.
I think we need to send the letters.
Yeah.
Me too.
I think we need to send the letters.
Because some of them are
We ask
retired.
Julie to follow, and the letter can say, Julie Miramontes will be contacting you in the future, in the near future, to discuss these options. And we just follow up with Julie to make sure that, did you get the letter? Did you read the letter? Did you throw it? Because a lot of these people probably are just throwing it. I mean, really, let's be serious. If they're on the money market, they're probably, everything they get from them, they're probably just trashing in the garbage in the circle, or, I mean, they're not reading that stuff.
Yeah.
So we sent a communication, and not our fault, because it's garbage. Then we followed up with Julie, said, did you read it? Because the rules have changed, and there's some risk here for you. I want to make sure you understand that, and what your options are. I think that would kind of,
So
because I don't really know where to put them.
Julie.
I'm comfortable about putting them in a fixed account, given the limitation. Particularly if these are people that think they have liquidity. The last thing I want to do is put them in some place where
Tie
they
them up.
have perhaps even less liquidity based on hiring of people to withdraw.
Right.
And that would not be good.
And again, I just want to go back and propose one concept one more time, is maybe something in the middle.
You think we might get it the third time?
Well, I don't know, but I don't know if you heard this consideration, but if you're proposing that you send the notice to 26 participants, and maybe that's a small enough number where Julie, knowing her audience, can actually, knows who they are, actually can make 26 touches verbally to tell them. That's
Well,
one
she only has to
thing.
make them before October.
Or
She can make 26 phone calls by October.
No, she can do it. To give people the option of staying in that fund that yields zero anyway.
Nothing.
If you just move that Dreyfus money market fund to a government money market fund, it still yields zero. If rates go up, it'll yield a little more than zero. And then
I remember you said that was really where my question was going before, is
Yeah.
could we add another fund
Oh,
that wouldn't compete with these, but
With
would
the
be-
stable fund.
oh, yeah.
Yeah.
Yeah,
And
yes.
You said no, and.
I'm sorry.
And it didn't follow, so, yeah.
I'm sorry,
Yeah,
my
adding,
question.
I think if you could add another.
If you can add
fund-
another fund that doesn't compete,
We can add
In the same category.
because there's already a Dreyfus institutional prime money market fund that's subject to redemption fees, floating net asset value, and redemption gates. I can identify a government money market fund, and we can transfer the assets. Again, another consideration.
If we had that option, then I would feel more comfortable about transferring that, just closing that into it.
Okay.
That's what we're talking about, yeah. Because it's still money market to money market.
Right. They still get.
And then,
Then there will be the stable NAV.
there still could be liquidity fees, but it doesn't really address what those are like.
Yeah, with prospectus disclosure, really what it comes down to is liquidity. That, in the prime money market fund, yes, you have some AAA rated government securities. You've got AA or AAA, AA, single A corporates. You've got bank notes. You've got even some non-investment grade securities in the institutional prime money market. Yes, it's all short term, like 90-day in duration. But the point is that the AAA stuff, when redemptions are made, that's what's going to be most liquid. Okay, that is going to hold up with the share price, high liquidity, and then based on how many redemption notices, the fund manager would have to dip down into those lower tier credit quality that are gonna be less liquid, that's, you know, where these liquidity fees, the floating NAV is gonna get hurt more, whereas in the government, you know, bonds, all AAA rated government, highly liquid, you know, that's why it's gonna have a stable NAV of $1, and will liquidity fees be imposed with prospectus disclosure? They're not gonna impose fees and then do the prospectus disclosure. They would, you know, have a prospectus saying, you know, we are going to impose it. So,
But somebody's gonna read it.
well, you think of everything, but, yeah.
I mean, I don't know how you feel, but I feel a lot more comfortable transferring them to another, a government money market fund,
I
and
would
that
too.
solves the problem of everything.
Yeah, it does.
Okay,
And then if they
so,
want to move it out of that, they can.
Yeah.
okay, so with that, then, version of this discussion, it's the letters, and Julie, well, Julie can still speak with them, but.
There's just no need to. We do the normal notice like any other fund where we.
That we're transferring,
Right.
we're
moving this-
we're mapping your money from
Mapping
breakfast
this
to
money
here.
market
Right.
fund to this other money market fund.
Okay, so really, it comes down, that's the least of all evils to do that.
That's what I.
Yep.
Okay.
That's what I- That's Rusty's motion, I second.
Yeah.
Yeah, I'm sorry, you did say that and I didn't connect the dots. That's why I was asking about another stable value fund. I wasn't thinking clearly.
No, that's fine.
And then I missed your suggestion. So you're right, the third time we got it.